Tesla is officially at a crossroads. While Elon Musk is busy winding down the Model S and Model X to build a robotic future with Optimus, the stock is fighting a brutal technical battle on the daily chart. As of today, February 2nd, the stock is down more than 4%. Now, is this a healthy refuel or the start of a deeper correction? Let's ignore the headlines and look at what the candles are actually telling us. Now, before we get into the Fibonacci levels, I have a goal for this community. If this video manages to get 100 likes, I will do a dedicated 1-hour business analysis of the potential SpaceX and xAI merger and how this impacts long-term valuation. So smash the like button right now and comment Tesla bull or Tesla bear to help us hit that goal. Now, Tesla's price action is currently trapped in a high stakes range. We're currently testing the $414 level and $415 zone. A failure to hold here opens the door for a retest of the major psychological support at 390, which aligns closely with the 0.38% Fibonacci retracement level. Now, if the bears win the $290 battle, the safety net is the 200-day moving average, which is slowly rising towards the $380 range. The daily chart is still currently showing a bearish price channel, and we've also seen price action break below its ascending Fibonacci retracement fan, which is a significant warning signal for the bulls. Now, looking at the engine of the stock with the momentum oscillators, we see that the RSI, with the 14 RSI, currently sitting at around 41 or 49, which is essentially neutral. This tells us that while the stock isn't oversold yet, the aggressive buying momentum we saw in late 2025 has completely cooled off. As well, if we look at the volume analysis, we see that there's bearish trading volume, which has been higher than the bullish volume recently. This suggests that big institutions might be taking profits, while the retail crowd is distracted by the Musk Incorporated rumors. Now, the road to $500 would be if the bulls can stage a comeback from these important levels. The first major hurdle is a cluster of short-term moving averages at around $431. Now, you would also need a daily close above 440 to regain a bullish bias. Still, the 52-week high sits at $489, and to get there, Tesla needs a catalyst slightly concrete mass production updates from Optimus later this year. Now, you have to remember that technical target from Dan Ives is $600 per share, while the bear case from Gordon Johnson is a terrifying $25. The charts are currently leaning closer to the neutral camp than either extreme. Now, transitioning towards the options market and what is currently pricing in on Tesla, we are seeing an expected move around 2% for the next 3 days. We have an upper bound of around $438, with the lower bound being at around $420, which would act as a level of support. Traders should deeply watch for the $410 level for the February 6th expiration. If Tesla sweeps below this weekly expected move, it often triggers a gamma-driven flush toward the $309 Fibonacci support level. Now, despite the 4% drop today, institutional flow is showing a fascinating divergence. We saw massive unusual activity at the $432 zone strike puts, with the volume exceeding open interest by around 40x, or around 16,500 contracts. This suggests that big players are buying insurance or hedging against a deeper slide. Interestingly, while the short-term sentiment is shaky, we saw a surge of around 12,500 contracts at the December 2026 $990 calls. This is a massive conviction bet that the Optimus Gen 3 and physical AI pivot will lead to a 100% gain by year end. Now, we do have to consider the max pain price, which would be for today's expiration around $427. Now, this strike price is known where the most option contracts, both puts and calls, expire worthless. Market makers often have a financial incentive to pin the stock near this price, and currently Tesla is trading at $419, which is $7 below the max pain level. If this magnetic pull kicks in, look for a late session squeeze back toward $427. Additionally from that, we also have to look at the put to call ratio and the skew analysis. We currently see that the interest ratio for put to call is around 0.63. Historically, a ratio below 0.70 is considered bullish, meaning that there are significantly more calls than puts open. However, the 25 delta put skew has ticked up around 1%, showing that while people are buying calls, they are paying a higher premium for puts to protect against a potential stock market correction. Overall, Tesla is no longer just a car company. It's a high beta AI infrastructure play with a 1.3 trillion market cap. Technically, we are in a wait and see zone, as a bounce off 414 could be a swing trade opportunity, but a breakdown below 390 would signal a much deeper I stage for the stock. Now, the question for you is, are you buying this 4% dip, or are you waiting for the chart to hit the $390 level? Drop your price prediction for Tesla in the comment section below. Smash that like button for that 1-hour masterclass, and I'll see you guys in the next video.